Okay, welcome everybody to MACROACE with your host Tony. Hopefully you're having a wonderful Wednesday. Just going to go through, we've got not too much to go through the Bank of Canada. There isn't a press conference which is expected, so there isn't going to be, there may not be a lot from the statement itself from the Bank of Canada. They are expected to keep their rates on hold at 5%. No surprises are expected from economists, but what I want to do is go through the sentiment, what's been said in the past statement and the meeting minutes, and what do investment banks feel about the Bank of Canada, what they might do at this meeting. So let's get into it then. So with the Bank of Canada, so first of all, we've got to understand how the rate decision affects the markets. As usual with currencies, whenever the rate is raised, then the currency sees an appreciation in the value. And or the other thing that can increase the value of the currency is if there is a hawkish statement that is provided with the rate decision as well. So whether the rate comes in as expected, or if it stays, or should I say, if it comes in as expected, if it stays flat, or if there's a rate cut. If the statement is hawkish, that can temper the market reaction, and actually you could see a bigger reaction depending on how hawkish the statement is. So what I'm saying is we have to be aware of the statement and the rate decision, because there could be a surprise that is in there that could be lurking around, and that we have to be aware of and be mindful of. So usually whenever rates are raised or there's a more hawkish than expected statement, it's favorable and more bullish for the currency. Then for the stock market, the flip side happens whenever you raise rates, or if there's a more hawkish statement, then the stock market usually takes a hit in anticipation of maybe higher for longer rates, or that the expectation wasn't met that would have been favorable for the stock market. So let's say at today's meeting, central bank decides to keep rates on hold, but says that they might have to continue raising rates more, or that they will need to raise rates rather than being prepared to raise rates depending on data. Then that could knock off some of the momentum that the stock market has already experienced so far. On the flip side, if you do get a more dovish than expected statement, or if you, for whatever reason, that there is a rate cut further down the line, and when it's not expected, then you could see a more bullish reaction from the stock market instead. So let me clarify that. For the stocks, higher than expected rate is bearish or a very hawkish statement. And on the flip side, a very dovish, more than dovish than expected statement, or a rate cut, or will lead to a bullish reaction from the stock market. Then bonds, similar thing with the currency. Whenever rates are raised, that increases the yield or that helps to boost the yield in the Canadian bond market, because there is the anticipation that rates, as said for the currency market, rates will stay high for longer, or rates could be raised again in the future. So all of these different effects on the market boil down to, what is the expectation? Has the expectation been met, or has it gone above or below? And then what is the current sentiment of the market too? Are they expecting a rate hike, or are they expecting maybe the central bank may be leaning towards a hike, although it might not be fully priced in, or vice versa? Are they leaning towards a cut that's kind of been priced in? That's what we've got to kind of think about and understand. But today's meeting, it's very clear cut. The central bank isn't expected to raise rates, and maybe until the first half of 2024, or maybe into the second half of 2024, that they're not expected to cut rates. But again, central bank hasn't made any discussions about talking haven't made any discussions about cutting rates. So if we do get a whiff of that in this statement with the rate decision that you have had some members talking about rate cuts, that could create a bearish reaction for the Canadian dollar and a bullish reaction for the stock market instead, and also bearish reaction for the bond yields. Now, where is the economy at the moment? So inflation at 3.1% compared to 3.8%. The core CPI, the CPI trim, is at 3.5% compared to 3.7%. GDP quarter-on-quarter annualized for the third quarter was at minus 1.1% compared to Q2's of minus 0.2%. Usually, what economists say, or a lot of people cite as the start of a recession, or if an economy is in a recession, without looking at the other economic indicators, is you have to have two back-to-back quarters. You have to have back-to-back quarters of negative GDP, and that's what would indicate a recession. At the moment, if you were looking at that, you might say, yeah, the Canadian economy is in a recession, but there are also other factors too that we have to take into account, like employment and what is what does consumer spending look like? How is the manufacturing sector faring within the economy too? Those are all the other aspects that we have to bear in mind as to whether or not the Canadian economy is actually in a recession or not. So talking about the employment data, what we had last Friday, it was at 24.9k compared to 17.5k. So still adding jobs to, remember, the employment change is the net amount of jobs that have been added to the economy. That doesn't mean how many people have taken up or have taken up jobs. It just shows you how many jobs have been created. So you can still see that, although not very strong, it's still above that negative level, and jobs are still being added. But you could say that with the lower figures that we have seen recently, that the labor market is loosening up a bit more, and that there isn't really a need to create that many new jobs to provide the productivity and growth within the economy. Average early earnings year on year was at 5% unchanged, which again is another key measure of inflation for wage prices. Unemployment rate ticked up to 5.8% compared to 5.7%. Retail sales, to look at how strong consumer spending was for the month, was at 0.6% compared to minus 0.1%. PPI data was at minus 2.7% for the year on year compared to 0.6%. And the raw material price index for the month on month was at minus 2.5% compared to 3.5%. Then finally, the manufacturing PMI data, weaker than the prior at 47.7 compared to 48.6. Now, the previous Bank of Canada rate decision on October 25th. So as expected, the rate was unchanged. And what they had said is that there is growing evidence in Canada that past rate hikes are dampening economic activity and relieving price pressures. And we've already seen that with the GDP figure that we've seen recently, minus 1.1% for the third quarter. And they also said they now expect inflation to return to the 2% target by the end of 2025. In July, they had previously thought that would be by mid-2025. So this is why the central bank has kept their hawkish tone within their statements so far. It is what traders are pricing in, that they're expecting the central bank to maintain their hawkish tone, that they need to keep rates where they are until they feel until they're comfortable that inflation is headed towards that 2% goal, and they will continue to do what is necessary to bring down inflation if there are any surprises, or they'll take action if needed this is the key thing, or the key comment to be aware of when we're talking about the language within rate statements, because a lot of people can be put off by it or might be a bit confused when you see all those headlines that come through, and you're listening to us on the microphone saying those headlines. We have to be careful of the specific phrases or sentences that the central bank has said in the past, and if they were to be removed, what reaction would the market have? So in this case, if they say that, if they do say that if they do remove the reference that they need to do anything, that they need to do more, that they're prepared to do more if needed. If they remove that reference from the statement in regards to inflation, that could provide a bearish reaction for the Canadian dollar, because the expectation is the central bank will remain firm in trying to show not only the economy but also the markets that they're going to do what's necessary to bring down inflation to the 2% goal. But if they remove any sort of reference of needing to or being prepared to raise, if they remove any reference of being prepared to raise rates if need be, then that would mean that the central bank is likely to pivot sooner rather than later. And on that note, you could also get comments from the central bank talking about rate cuts and when they could occur. But that might be pushing it, because central banks don't usually provide so many big surprises in a rate statement. And as I said, there is no press conference. So it means that if they're that at this point, they might not be deciding, they might not have made a decision to do anything else, but just to keep rates where they are and just regurgitate what they've said in the past. Also, what they said is that inflation is to average 3.9% this year versus 3.7% in July, at 3% in 2024, 2.5% versus 2.5% to 2.2% and 2.1%. Okay, for 2025. All right, so what else do we have? So for the meeting minutes, November 8th, they said, so ahead of the Bank of Canada's rate statement, some members of the Governing Council felt rates would more likely than not need to increase further. If global financial conditions tighten further or past hikes restrain demand more than expected, the economy could be weaker and inflation lower than projected. So this is how traders should be using the meeting minutes. Usually, if there hasn't been any major data that has changed sentiment or flipped it around, like inflation, if inflation hasn't been a surprise, then you can use the meeting minutes as to what it's not really a great indicator of what you could expect, what could be said in the next statement, but it gives you a bit of an inkling and an idea as to what central bank members are feeling in the Bank of Canada. So if we carry on, they also said that other council members felt 5% rate would be likely enough to bring inflation down to the 2% target, provided that it was maintained at the level for long enough. So again, the idea of another hike would only come about if inflation data proved to be stronger in the future and wasn't going down in this nice disinflation that we're seeing at the moment from Canada. Bank of Canada views then, again, not too much from Bank of Canada's members. They rarely speak that much after they've delivered their rate decisions, or their comments don't really hold that much sway on the markets, because they're more repeated. and everyone else at the moment is looking to what the Federal Reserve is going to do, because then that will have an influence on what other central bankers will do instead. So November 22nd, you have Bank of Canada's Governor Macklem said that the economy is approaching or is already in excess supply. So when we're talking about supply and demand and how that affects inflation, basic principle is the more demand that you have than there is supply, the higher those prices would go up for those goods or services. The less demand and more supply you have, the cheaper those prices are to try and attract those customers, those buyers to jump onto your product or service. October 30th, he also said that we held our policy rate steady because monetary policy is working to cool the economy and relieve price pressures. And Bank of Canada's Senior Deputy Governor Rogers said that the Bank of Canada is not yet talking about reducing rates. So those are the only three headlines or bits of news that were quite important to understand here for the upcoming rate decision, because it's very unlikely that the central bank would flip or decide to take a rate hike instead, which would go against what they've kind of already said in their past statements or comments. But it is up for surprise. The central bank has surprised markets twice so far. In this year and maybe last. I think this year definitely they have done for sure. They have surprised the markets with an bigger than expected rate hike. Okay, and then sentiment and views from investment banks. So you had ING that said there is modest room for a hawkish, although short-lived market reaction. And markets are pricing in 100 basis points of cuts in 2024 in Canada. So it is likely that the expectations are leaning towards a softening of the hawkish tone by the Bank of Canada at this meeting. CIBC said that it's readily apparent in the past 2 quarters, interest rates in the 5% range are a significant headwind to growth, and one that is desirable now while the Bank of Canada seeks to cool inflation, but too much of a drag to be sustained for a full year ahead. Don't forget, if you like the video so far, don't forget to give the video a like, a thumbs up, subscribe to the channel, share the video too. We'll be doing a little bit of post analysis of the comments that have been made by the comments that have been made in the statement. And then we had the Bank of New York, or BNY. They said that the Canadian Central Bank may try to sound tough, but the data and market make it clear that holding at 5% is the logical outcome. And that was according to Bank of New York's Bob Savage. So the economists are expecting no change. The markets are expecting no change. It's all down to the language. So if there is a bit of softening of the language from the central bank, that if inflation, let's say for instance, inflation is making headway towards the 2% goal, but they're still prepared to raise rates if needed, if there are any surprises, or if the labor market is seeing to Puya, I think you said the wrong thing in the chat. I think you might want to check your spelling. Oh boy. Anyway, getting back to this, we've got about 10 minutes, so it's all right. We've got the previous live stream for the Bank of Canada to go through. I won't say that on the mic. So, as I was saying, statement is going to be key today. If the central bank keeps rates on hold as expected, and if that's what markets are expecting. However, if they do decide raise rates once more and make it their final rate hike for this year, then that would definitely add to a bullish reaction for the Canadian dollar and a bearish reaction for the stock market, because it's not expected. Again, it's all about the expectation of what markets and investment banks are expecting from the central bank. If the expectation isn't met. If it goes above and beyond and there's a surprise, you get more volatility and you get bigger market moves that could occur. So let's go on to the last rate decision that we had seen from last time around. So this is about 10 seconds before the release back on October 25th. And what you'll see is that there wasn't too much of a great amount of movement from the decision. So the rate comes in as expected. So sometimes what will happen is, if there isn't anything that's clear cut from the statement that's very hawkish or dovish, the markets will kind of take their time to kind of digest what's being said and then go in the direction that they want to go into. So you can see here with the Canadian dollar, we did see a little bit of weakness, but there wasn't anything new that was provided by the central bank or anything that would have surprised the markets. Hence, you get this reaction here where it's more muted. So that's why it's important to try and underpin or understand what kind of language the central bank could use in their rate statement. Let's kind of skip ahead. Kind of see how much more there was. Yeah. So it was sustained in one direction, but it wasn't as big or as strong as we have seen in the past, when there have been more surprises that have been provided by the central bank. So if I just get rid of that, get out of here. Let's get the deviations sheet. Okay, here we are. Okay. So bear in mind, if you haven't had a look at the ranges of deviation sheet, or you want to, if you want access to it, all you got to do is subscribe to the MACROACE mailing list, and you get that. And on the Monday, you'll get that completely for free. There, that's the link there. Subscribe to the mailing list. But yeah, so as you can see here, the last rate decision. So in the deviation sheet, what I noted is that what led to the decline in the Canadian dollar was the Bank of Canada saying that there is growing evidence in Canada that past rate hikes are dampening economic activity and relieving price pressures. So not a huge amount of dovishness, but just more, let's say, an acceptance that inflation is headed towards their 2% goal, and their job and their rate hikes are working. And again, as I said, there was nothing else that the Bank of Canada said that was a surprise, hence the muted reaction. So what do we kind of want to see in the past? Let's have a look at July 12th. We'd seen a much stronger reaction from the, well, let's say one example where the rate was as expected, but we'll have a more stronger reaction. The Bank of Canada said they remained concerned with inflation and expect a better performing economy. Canadian money markets post the release see the Bank of Canada policy rate at 5.14% compared to 5.08% before the rate hike. So that's speculation from the more hawkish than expected central bank in their statement, provided that volatility. So we go back to June 7th when there was a surprise rate hike instead. Let's go here. There we go. So when they delivered their surprise rate hike of 25 base points, you can see here that the market reaction was very strong on GBP CAD. And in general, whilst we're looking at it here, GBP CAD has had the strongest market reaction out of all the currency pairs that we have here that we've seen. So about 80.5 pips towards the downside. And then after about 10 minutes of trading is what the bracket in black represents. Going to the end of the candle, it clawed back some of its initial losses, but it was still down by 59 pips. So that's something that we've got to be aware of, is that with these rate decisions, is how long will the market reaction last? And in a lot of the cases that we've seen here historically, there has been a bit of a clawback after about 10 minutes of trading. Sometimes I'm just trying to find an example here. Nope. I was trying to get an example where it might have continued its momentum. If I look at the FMC rate, yeah, dead. Yeah, but you can see here with the FMC that there's been more of a stronger market reaction. What I mean is that the market reaction has kind of been sustained and is either headed higher or lower, depending on what the initial market reaction was. But here in the Bank of Canada, you don't really get that of what we've seen so far, anyways. But yeah, so this figure here in the blue brackets represents the market reaction 10 minutes after, 30 minutes after the economic release has occurred. And you can see here that last time round, the movement 10 minutes after the release was stronger than the initial market reaction. But again, a lot of the other, so again, GPCAD having the strongest market reaction is the one that we have seen here. That's kind of sustained itself, or it sustained itself last time around. The other ones, more or less, tried to more or less were paring back some of their, either paring back their losses or paring some of their gains. Okay. All right, so we've got about 3 minutes left. Let's close this here. Let's get TICKSTRIKE up and ready. Okay. Right. I'm going to go quiet for a little bit. Just going to get myself set up. Okay. All right. Not too long left to go now. So we've got GPCAD up here. We've got the dollar CAD next to it. We've got the Canadian Swiss franc and CAD JPY. We've also got the Euro CAD here. So we've got less than a minute to go. As I said, if you like the video so far, or if you've liked the videos in the past, don't forget to give us a like, a thumbs up, share the video, and also subscribe to the channel. All right. About 40 or so seconds left. So what I'll be doing is I'll be, once we get the rate decision, I'll need to have a look at what the rate statement has said. If there are no surprises with the rate first, which is unlikely, but the Bank of Canada has surprised in the past. So I'm not throwing it out of the window altogether. Okay, 10 seconds. No change as expected. Okay, let's see what the Bank of Canada said. All right, still concerned about risks to inflation, but statement drops October language that inflation risks are increasing. Okay, so what else we got there? High rates are clearly restraining spending. The labour market continues to ease. Just seeing some strengthening there. A little bit of strengthening from the Canadian dollar. Let's see what else they have. Okay. All right. So I guess the key, there isn't really anything else here. They reiterate that they remain prepared to hike rates if needed, But the key point, they're still concerned about the risks to inflation, but they did drop the October language about inflation risks increasing. So things are more or less going towards the central bank's goal, but they're not really. What it is telling us is they're not ready to talk about rate cuts yet. They want to see further and sustained easing in core inflation, and continue to focus on balance of supply and demand in the economy and inflation expectations. Other than that, it's very quiet. I'd say recent job data and Q4 indicators suggest the economy is no longer in excess demand. So again, it's talking about excess supply there within the economy. Let's do some quick measurements to GPCAD. See if it did. I mean, it was very minimal. It wasn't really a great deal that came from it. Okay, so about 14 pips down off the back of that. So what it tells us is that the statement and the rate itself isn't really doing that much, or hasn't really surprised the markets enough for them to go and turn on that volatility, turn on that pump mode, or go crazy, should I say. Okay. That basically that concludes the live stream. So again, not that much that happened from the Bank of Canada. Yeah. Okay, so that's my current position that I have at the moment. What you can see there, and I'll leave that to do its thing. If you didn't see that. So with the Canadian dollar still going, according to TICKSTRIKE, see it do its thing. Okay, so as I said, that concludes the rate decision and the live stream for it. Thank you very much for joining me live. I hopefully you found that useful. If you did, as I said, don't forget to like the video, subscribe to the channel, get the word out there, and I will see you guys next time. Now, very important, Friday, we have non-farm payrolls. I don't think I was able to do the last non-farm payrolls, or I was able to do the last non-farm payrolls. I've been ill quite a lot here and there, but rest assured. So as said, non-farm payrolls Friday, which I'll provide the link for you guys. Let me just grab that here. Let's see, where are we? There we go. Gotcha. There we are. Okay. That is a link for tomorrow. Excuse me, not tomorrow. That's the link for Friday for the non-farm payrolls data. I did close my position, by the way. So yeah. But as I said, so that's a live link there for non-farm payrolls, and you can join me there for Friday at 8 a.m. Eastern Time live. Again, going through the sentiment, what has the Fed said in the past? What are they expected to? What could happen with the market reaction for non-farm payrolls, and what else to expect from it? But yeah, so if you would like access to the deviations Google Sheet as to how the markets have reacted in the past to previous releases, then as said, you can click on the link here, which I'll pin there, which is to MACROACE. So you'll get an email on Monday morning with the link to the deviations, to the Google Sheet ranges and deviations. You'll also get the upcoming live streams as well for the videos, and then also a short summary of what to expect for the week ahead in the Europe, US, and Asia session. It isn't filled with a lot of detail. It just gives you a little basic rundown of what to expect, what's happened in the past, and then it acts as more of a refresher. Very short, quite concise, unless I do add in some other bits of detail that kind of need to be clarified, like we had with gold, which touched an all-time high. The Asia market open on Sunday because of the expectation of the Fed and the rate cut bets that have occurred so far. But yeah, because there wasn't any news for it, that caused caused gold to go towards let's see, a big old pump from the market open. So yeah, so that's a link to MACROACE. Now, FinancialJuice, as you can see here, so we have FinancialJuice is a live voice and text service, providing you with up-to-date news of what's going on within the markets, what a central bank is saying, and then of course on the left. So here we have our live voice feed, which you should be able to see here. Okay, and whenever there's a headline that's important or that's key for sentiment, then we'll say that over the microphone, and then you'll be able to hear us say that. And then of course here we have our news feed of the text version of what we said here, or if there's a video or if there's a statement that's to be released, that's also there as well in the center. And on the left hand side you have the economic calendar for the data for the week ahead, and of what to expect if there are any key events, like the Bank of Canada rate decision or JOLTS, what we had yesterday, and then non-farm payrolls on Friday. So everything's all in one place, and you can subscribe to you can sign up to FinancialJuice completely for free. Okay, you have the live version, which is still very useful to be able to. So that's if you've never come across a live voice and text service, or if you're not sure of how to utilize live voice and text service within your trading. Sign up to the light version, have a little play around. The light version, there is a delay, there are adverts, but it'll still be useful for you to get an idea and see whether or not it'll be useful for you to go for the pro version, which the pro version, there is a 7-day free trial of that. And with the pro version, you have no delays. It's all live in real time with the data, the headlines, and the voice. And you also have access to the news desk as well to be able to ask questions, which you can see in the bottom right-hand corner with a little, there we go, with a little blue message box there. So that's FinancialJuice. Now, if you want to go pro straight away, then of course you can do that, but make sure you have an account on FinancialJuice first, and that you've verified your account from your email. Then if you want to go pro, there'll be a button in the left hand corner, as you can see here, where I'm clicking the slider. It will say go pro there. Select the subscription that you want to go with. Once you've done that, log out of FinancialJuice and then log back in, and you should be able to see the beautiful site that I see. Also make sure if you have any VPNs or if you have any ad blocks like that running, then that's going to cause that could cause issues. So just be careful not to have any VPNs running. We have had that in the past, but yeah. So please don't have any VPNs running, and the site should just run as normal. If you still want to use the VPN, and if it works for you, then fine. But as I said, you can face issues. So just giving you a bit of a heads up, just in case. But yeah, so that's FinancialJuice. So you can have a little play with that. This is TICKSTRIKE. So what I was using with TICKSTRIKE to kind of see what the market reaction was like for the for CAD JPY when I was trading that there. TICKSTRIKE is quite useful. So TICKSTRIKE allows you to listen to the volume, or or another way to put it is how strong is the buying or selling momentum, and it lets you see it, and also hear it too via this ticker box here. So with the color, of course, the minus figure being the sell, and the plus figure being the buy side or the buying amount. And this little slider here represents the sensitivity of the ticker. So level 1 is the most sensitive to market reactions. So when you have it on level 1, when there's a little bit of buying or selling that is occurring, as you can see here, then TICKSTRIKE will give you that visual and audio alert, or you can decide which way. You can have either visual or audio, and you can change the color of it too from the settings. And as you increase that level, or kind of chop and change it, 15 is the least sensitive to market reactions. So only when there's a big amount of buying or selling momentum that occurs will TICKSTRIKE go off. So you can see here when there's a little bit of buying on CAD JPY, buying momentum, I put this all the way to 15. So only when there's a big amount of buying or selling that's occurring will that then go off. If you're a day trader and you want to manage your risks or capitalize on potential opportunities, then again, that's quite useful. It's a useful tool to use. And then one final feature that we have for TICKSTRIKE is the lightning bolt symbol. So the lightning bolt here is 15 levels below 1. So if 1 is the most sensitive, and now you're going to minus 15, it's uber sensitive. So you see all the little bits of buying or selling that is occurring within that asset. So TICKSTRIKE doesn't just cover FX, it also covers stocks, futures, cryptos, ETFs and ETNs, and your internals like the VIX index as well. You can also have a look at that as well there. So again, if you're a scalper, that's what the lightning symbol is really made for. Doesn't mean you can't have a play around with it. I don't have a play around with it because it's a bit too much for me to see all of that. So I kind of keep that off. But if that's your style, and if you want to see how those little bits here and there moving around, then by all means do it if that works for you. But if you want to have a little play around, we do have the free version of TICKSTRIKE on the FinancialJuice newsfeed on the homepage. Okay, here should be able to see there. Okay, but it's limited to the strength or the sensitivity, and you're limited to the 4 different asset classes with just the S&P, the euro dollar, oil, and Bitcoin. Okay, and nothing else. But if you want to have a little play around before you do the trial, you can do a trial of the trial, right? The forever trial, and then the trial, a 7-day free trial. So on the feed here, you can have a little play with it, see if it works for you, how you can incorporate it in your trading, and then when you feel ready, then you can have a little play with the trial, and then when you're ready, go for the full version, and you can play with all the different assets that we have on TICKSTRIKE. Okay, thank you very much, ladies and gentlemen. Enjoy your trading day. Hopefully you found this information useful. Take care and goodbye.